today we're going to talk largely about moving averages. And remember, what we've spoken about in the past here is that, to me, price action and visual support and resistance are 80% of the strategy, and market fractals, sort of the multiple time frames, really the bulk of a sound trading strategy. Then things like oscillators, things like Fibonacci, things like moving averages, pivots, these are all complementary things to your price action support and resistance strategy. All right, I don't know, and obviously it's just my opinion, I'm not sure that you can use just moving averages for a strategy. Things like stochastic or things like oscillators and EMAs are attractive to a newer trader because they're sort of black or white. X crosses X and you do Y. And moving averages are sort of nice, shiny, visual things to look at. But if you took them off my charts, it wouldn't hurt my feelings, So you can, just looking at this 4-hour Euro chart right now, it's not very difficult to see, where your support and resistance is based on just the candles, right? You don't have to be a genius to work this stuff out. Support, potentially support. Said differently, resistance, support, resistance, etc. So when you are looking for your basic visual support and resistance areas, you're doing yourself a disservice by not having just a clean naked chart. Okay, so I want to say that right out the chute. All right, now, moving averages are an interesting tool because they inherently lag, probably more so than most other indicators that we use in trading. So it is important that when one has EMAs, or we use exponential moving averages principally here at Bootcamp, it is important that you anticipate where and when the EMA is going to be. All right. Now, there's two rules to moving averages that one has to keep in mind. All right. One is that they can, or properties I should say, one is that they act as good dynamic support and resistance. All right. And then two, the angle at which your moving averages are is important. Okay. So in other words, a moving average that's sharply pointed down is going to repel price, all right, and act as dynamic resistance. Dynamic because it's moving. It's not, when you're talking about a visual area, you're talking about sort of a static zone that's important, all right? But when you're talking about a moving average, it's going to roll dynamically with price. An EMA that's flat, price is going to have no problem just running through it. It's almost, moving averages that are flat are almost not important to me. Okay? They're only important if they are sharply pointed down or sharply pointed up. Okay? Now at FX Bootcamp we use a couple of different ones. We use the 5 EMA, which is this maroon one here. So we use the 5 EMA, and then we'll use an 8 SMA set to open. Alright, set to open. And these two moving averages basically represent the immediate price action in the market. Alright, I'm not sure I'm gonna deal with this as how it contextually figures out through multiple time frames. We'll look at this sort of on one time frame and then go from there. Alright? So the 5 EMA and the 8 SMA represent price. Okay, and then we use the 21 EMA and the 55 EMA, and these represent more the market direction. Alright, so if the 21 is above the 55, it generally means that the market is heading up. This is a 50-minute chart, so they're going to change quite frequently. but this holds much more weight on a daily or a 4-hour chart. All right, and these are two medium to moving averages. Once again, the angle and separation, the angle between them is representative of the market speed, and then we'll use a 200 EMA as well, which will basically represent the trend of the market. All right, so 5 EMA, all the EMAs are set to close, the 8 SMA is set to open. All right, and these are the moving averages that we use. All right, now to me, EMAs are, now if we, if I put our normal setup on here, we do it like this. All right, there it is. Fairly busy for you, but you'll see basically, and I'll take the Bollinger Bands off here, you'll see basically that when the 2155 crosses, which occurred back here, this doesn't happen a whole lot. All right, and prices basically, even though the 5/8 has crossed several times, all right, which is our price action, and I've just dropped the air quotes on you there, which is silly since this is a computer video, but the 5/8, which is price action, can move independently within the context of the overall trend. Thank you. All right. However, the 21 being below the 55 dictates the overall sort of direction of the major market here. All right. And I think that is largely what's important. And this is obviously much more important when you start to look at things like a daily chart. Notice now that we're below the 21, here we had a 2155 cross, price sort of retested that, and the market, the 21 was above the 55, and largely, the market was up. Now keep in mind that these things lag massively. All right, now we're below 2155 is crossed, and now we're below this, therefore we are bearish until proven otherwise. All right, now if we look at something like this, all right, let's go to the yen for a minute. Okay, and here we go. All right, so this is a nice, I call this my little envelope setup. I'm not sure that this is the best the best way to go trading, just because it's such a lagging sort of system, so to speak. But it represents what I want to talk about in terms of the speed of the market, all right? And basically it's as follows. Okay, when the envelope is established in a direction, so in other words, all the reds are below the blues and the greens, the general market action is to the downside. And when they're crossing over each other, the market is in a decision mode. So if you look to the left here, notice how the envelope is not established in any direction, therefore it's a neutral market. Here we sort of break above it, we get momentarily established, but we're really not, so that doesn't generate a long signal. Here we re-establish the envelope to the downside. These are just EMAs, 5 EMAs apart all the way to 100. So 5, 10, 15, 25, 30, 35, 40, all the way to 100. And when the envelope is all established below each other to the downside, the market is in a generally downside directional posture, so to speak. Now, does that mean that you're immediately short? No. But you can look to short in your red zone after an established envelope to the downside, right? And this can be applied to multiple time frames, all right? Now, notice here how we go into a neutral phase. Notice how the envelope is not established. All the EMAs are crossing over each other. That is a very good indication of a market that is neutral and a not particularly fertile trading environment. Okay? But then notice here how we establish the envelope to the upside. The reds are below the blues. Check that. The reds are above the blues or above the greens. We have an established new trend to the upside. So it's gone bearish, neutral, bullish. All right, and then price heads up for a significant amount of time. And once again, we've gone back into a neutral environment here. All the moving averages are now heading sideways, sideways, sideways. Never really established the envelope. Alright, then we finally do establish it back to the upside. The reds are above the blues, above the greens. And notice how, I'm showing this as more of an illustration of the trend, but notice how, all the EMAs are blurred into each other, crossing. Here, angle and separation between them. They sharply pointed up, where here they're normally flat, therefore price can break them. Okay? And notice here how they acted each time we tested the envelope in this established trend, how that propelled us to the upside. Alright? And every time you get a little too far away from it, that's generally a sign that you want to correct to them. Alright? So this is another nice way of using EMAs as far as overbought and oversold indications in the market. Alright, so let me get rid of a couple of these. Okay, and we'll just keep the 21 EMA. We'll keep the 21 EMA on our screen here a sec. Alright, so this is a 21 EMA on a daily Euro chart. And what's pretty cool is how these EMAs can represent mean reversion sort of distances, if you will, relative to price. So if we just look to the left here a little bit, take the scroll off. Okay, and we take sort of the most extreme distance, if you will, from this 21 EMA. So we'll measure this oversold zone here. You'll notice how if we just take that measurement and then move it around to where price was mostly overbought and oversold, you'll notice that this distance repeats itself fairly regularly. In fact, we've actually, this is the most oversold we've been. And if you just take that, you'll notice that we very seldom, I'm not dragging it around yet, we very seldom will exceed that amount of distance, if you will, relative to the 21 EMA. So when you have stretched out, these distances repeat themselves. Price doesn't necessarily mean that price is going to reverse, but it generally means that price will want to correct. All right, and notice how when you have, notice how when price is above the 21 EMA, we're generally moving up, and when we're below it, we're generally moving down. And when it's flat, price can go through it. All right, when it's flat, price can go through it. So moving averages act as good indication of direction and basic market direction. They act as good means of dynamic support and resistance, as long as they are showing good angle. Alright, flat ones price can go through. Okay, and they also good indicators of overbought and oversold conditions in the market. So use them sparingly. Use them. I think it's important to anticipate which way you think that they're gonna show up in the market, as opposed to follow them. I think that they have to follow your analysis, and then the angle by which they up or down is a good indication of whether they're going to act as good kickoff areas for dynamic support and resistance. All right. If you like what's going on here, very basic lesson. I'd encourage you to watch the other lessons in the series. This is the 7th. If you like what's going on here, thumbs up the video or leave me some feedback on YouTube or on my Twitter at Forex David, or you can reach me at david@fxbootcamp.com for my email. Thanks everybody. Talk to you soon.